Okay, we did it. Sasha, we're on.
Okay, what is the intro?
The intro, okay, here's the problem. Even though we're live now, they never trained me how to do the intro. Okay,
Okay,
so I didn't do it this morning and I didn't do it now because I just got no training on it. I talked to Jim. I
that,
said, it's in the system somewhere, but only a couple of people know where it is, and I've still not been able to find it. So we're
you're not one
live.
of those two.
We're live, but the intro, as a matter of fact, I've got to change the banner. No, it's going to start up Wednesday. I will work on that. So just give me a little time while you're
No
talking.
problem.
I will go work on the banner.
Okay, thank you. Okay, so welcome to Investment Show. It's IBMTV, Wednesday, 1 o'clock or so. So let's continue to talk about the market and what we've learned in the last couple of sessions. First of all, let me remind you, rule number one, it's whatever you're doing, your goal is preservation of capital. That's rule number one. The second rule is just as simple because it treats exactly the same preservation of capital. And rule number three, look, rule number one and number two, it's preservation of capital. So if that's really all what you're trying to do in investing, then of course you have to be very selective at your investment strategy, the tools you're using, the stock selections, and so is option selections and many other things. But this is rule number one, two, and three. And last time we discussed an options as an instrument that would help you to maximize your return on investment. To tell the truth, with fixed income paying you're lucky to get even 1%, in many cases even less. If you're talking about even like municipal bonds or just anything, whatever will give you a protection and some income, you're almost forced to do stocks, naked stocks, or covered calls, or options, or any other instruments, because I don't think that anybody will be happy with a uh, say 1% return. Let's say you can find some more or less protected investments and getting 1% return, but for most people it's not enough. For retirees, it's a horrible proposition to get only 1%. And don't know, maybe some of you are satisfied with that. Okay, let me introduce our guests. Okay, here is Shakil Latimer. Hello, how are you doing? Are you asleep or about to be asleep?
No,
Okay.
I've stayed up. I've sat up, and I put a very colourful Australian shirt on. This is from Cairns, up in
Hmm.
Australia. Oh, wrong side. Cairns, up in Australia. So that's the one of the most northern parts of Australia. So I thought I'd add some colour to
Good, very
the
good. We started a discussion a couple of days ago about, and we continue that. And we also have Jim Eads, Chefs Without Borders. Okay, now I can see Jim. How are you today?
I
So,
am terrific.
uh, so
And I got the same problem that Shaquille has.
mm,
I was trying. I know you're from San Francisco, so I was trying to be more colourful. I
Yes,
think.
good job. Good
I think
job,
I've won.
Shaquille. Tip of the hat. We got to
okay,
work on Sasha.
yeah, okay. Actually, I had a colorful shirt before, but I changed now to more solid one. But it doesn't matter. We're having a pretty good day today. Dow Jones is up. The stocks that I are watching also a little bit higher. I see my favorite stock, General Electric, is a little bit higher today. Mm, Although I'm in a bid to liquidate my position. So
It's all green.
yeah, anything is green today.
All green.
So tell me,
All
Jim,
green.
how's your day on the market today?
Well, I'm looking at. I'm all green too. GE is up over 7.
Yeah.
That's so good for you. I think the way you played the
yeah.
market and the options, I'm not sure if that's good news or bad news for you. Do you want GE to go up?
Yes, I do want, because look, I sold November 8 calls. So as long as it's not going higher than $8 by November 20th, it's all money in my pocket. Now, if it will go higher than 8, then I will have to make some decisions. The decisions will be whether to roll over my 8 calls into January 8 calls or maybe even January 9 calls. Depends where the stock is. I have to wrestle the decision, or just get rid of it and let them exercise me and just take my stock away from me. If I paid $6.95 and I got $1.07 for an option, so my price of stock is essentially $5 and some 88 cents, and I will sell it at 8. It's okay. I will try. Yeah.
So you don't want it to go down so that your $8 calls are more valuable?
You know what? It's really hard to figure out what is my ideal scenario, because the pain starts if the stock will go down from 588 and lower. Then I will start, at least it's a paper loss, but still a loss, and I have to wrestle with that. And I will have to make some decisions to continue to hold on to that and maybe sell some more calls to offset my loss. But you know, I don't like this position. I don't like when I have a losing position. I'd rather liquidate it than to work on it. You know, because there are so many wonderful opportunities around. What is it? My wife? Is it my relative? Why do I have to worry so much about the General Electric? It's a stock. It's there for me to make money. It's
Yes.
not to suffer. No.
No.
So as long as it's staying above 588, which it's never been so low since I acquired the stock about a couple of months ago. So I'm okay with that. Now, if it will go anywhere to $8 and or about $8, it's all fine. It's all money in my pocket. Now, if it goes $8 and higher, as I said before, I'll have to make some decisions. But I have to see what's happened at the time. How is the economy doing? How is General Electric? I have to value many things. My first inclination would be just to let it go, just to get up stock at $8. So I bought it at 588. I sold it at 8. It all took me 4 months. That's not a bad return on the investment. What do you think, Jim?
Well, I think you're right, but it seems to me that you've got to find the balance between you bought actual shares at 580.85.
No, my actual shares, my cost is 692. No, 696 minus $7, which I received as a premium for my options, my calls that I sold against stock. So my actual price is 588, but stock cost me almost 690, almost 7. But don't forget that I received premium $1.07 for a call.
Right. So if I'm understanding you correctly, if it's over $7, then you're in the money either way. But if it goes over $8, you've got some decisions to make.
Yes.
Yes.
If it's 8 or lower, then I will retain the stock. The options will expire worthless, and I will be at that point. I will probably sell more $8 calls, probably January expiration. Most likely, that's what I will do. Because at that time I will make so much money that my effective price of the stock will be, it's 588, and it's trading at 8. So I'm already, I can't lose this position anymore. So even if I will sell farther, say January, $8 calls, it will generate me another, I don't know what time or how much they will cost at the time, but let's imagine they will cost, say, 75 cents to make it clear. So then my price of the stock will be 588 minus 75, so it's slightly over $5. And stock is trading at about $8. So you can count how much money I'm making on stock.
Yeah, I'm starting to understand what you're doing. I'm just getting a little closer to understanding what you're doing.
I'm not even taking into consideration the fact that the stock pays some dividends.
Right.
And I'm not taking into consideration that I buy it on margin anyway. So you can calculate that, that this position alone generates a hell of a lot of profit. And if you're talking about the alternative to go into fixed income and create and be paid 1% a year,
Oh, yeah, that's
definitely what I'm doing beats it.
oh
Yeah,
yeah.
but Sasha, and we had this conversation yesterday.
Yep.
You know, you guys are all chess players, so I can get away with saying this. So my favorite open is the King's Gambit. Why? Because it's fun, it's exciting, it's unbalanced, and at high school level and at sort of junior club level, I'm going to get away with it because I'm going to have intimidated most of my opponents, and you know I'm going to win a lot of my games. When I come to actually playing a serious game of chess against one of you guys, I may hesitate before I open with a King's Gambit move because, you know, whilst I know the lines pretty well, I know that there's going to be some things, other things I'm going to need to do. This is really the same thing with trading. You know, it's okay to say, hey, this return is much better than the return I would have got on fixed income paying 1% per annum. But you could go to the casino and put some money in the slot machine, and there's a reasonable chance that you're going to beat the return that you would have had if you were to have put your money into fixed income.
Disagree.
So my point being is
Disagree.
that what
I
is
strongly, very strongly disagree with what you just said.
This makes
Because
a good show.
on a machine in Las Vegas, there is no guarantee of any profit whatsoever. In fact, most likely you will lose money, especially on machine. And blackjack is a different proposition.
Right,
I would agree, but perhaps with a blackjack.
Well,
But
I won't
no,
argue with you about the mathematics of gambling, but the point that I'm trying to make is the risk that you're taking doing what you're doing is substantially higher, at least theoretically, as than the risk that you're taking if you are going to trade a fixed income security.
Well, that's why you're paid so much more money for taking this calculated risk. I can't deny that there is a risk. There is a quite possibility that General Electric can go down to $4. Of course, in this case, I will lose money. This is why I'm sitting on a bid to unload my position to General Electric, by the way. However, I'm prepared to take this amount of risk because of the very significant return that I most likely will generate. I have only two questions: how much money and how quickly? Okay.
Okay, then let's go back to the example of Vegas then. Let's say I go to Vegas, and I'm not, and please, again, this is not financial advice. I gave that disclaimer the other day, so for Nick's sake, this is not financial advice. Please don't listen to anything that I'm saying. It's just my opinion. But why not go to Vegas, take the same money, and say, okay, the Vegas slot machines, and I can't remember what their payout rates are, but I think the theoreticals are around 98 to 99% return to player. I put my money in the machine. If I lose, hey, it's no big deal. I live in San Francisco, right next door to Jim. So I get a nice trip over to Vegas, you know, get to hang out. I get a sunburn head, get to hang out at a pool, get a free trip, get a free few meals, free hotel room, get to come back. I had a good time. And whilst statistically speaking, I should have lost money, there was a chance that I could make something.
Okay.
You know, that is always the case. I'm not saying that selling covered calls against stock that you own is always a bad idea, but as I said to you yesterday, you know, in our private conversation, please remember that we are taking on a certain level of risk when we're doing this, and there is another side of your trade. There is somebody on the other side of your trade, and it's not normally a person. It's an institution. It's a market maker. It is, you know, a group of investors that are transacting billions and billions of dollars at a time. They're not in the business of losing money. They're doing something. And so you may find that your trading strategy creates a profit, but doesn't create as much of a profit as you could have made had you structured the trade differently. That's the only point that I would kind of like to share on that issue.
Yeah.
A question: what your example with Las Vegas has to do with the trade that we are discussing of General Electric?
Well, the example there was that people sometimes take inordinate risks on the market where they think they are safe, but they're actually taking a lot more risks than what they believe they're taking. And when they do that, they are gambling on something occurring or not occurring on the market. My opinion is, if you're going to gamble on the market, you might as well gamble at the casino, because at least you get a couple of free tickets to a show and a free meal and a hotel room. But more prevalently, to your point, General Electric would seem, if you look at its historical average, would seem like it's at a really attractive price right now. If you have a look at a company like Hertz that filed for bankruptcy protection a handful of weeks ago, its price looked very, very attractive just after it did that, and it went up 900% in a week or 10 days or something. Okay, but when you entered those sorts of positions, the risks that you were taking were substantially higher. Now, the reason why General Electric's share price is so low is because it is so much more risky a proposition right now than, I don't know, AT&T would be right now, or Verizon, or some of those sorts of companies.
No, I agree. They're fantastic stocks, and I usually own at least one of them, sometimes both. But with General Electric, there was something else. In my opinion, General Electric, if they would fix their problems, they will fix, but it will take probably a couple of years. That's a problem, which I didn't realize. And this is why I'm going probably to sell it well before November 20th. The problem is this. So, although I still think that it's very well priced.
Why will General Electric fix their problems? What makes General Electric any better or worse a stock than Enron? I mean, I believe that if you go to the pink, the over-the-counter pinks at the moment, I believe you can still buy stock in Enron. I might be wrong about that, but I'm pretty sure you still can. They seem, really quite cheap compared to the historical average. Maybe one day they'll fix their problems. Same thing with companies like WorldCom. Same things with companies like Lehman Brothers. But to take an even more prevalent example for California, and please forgive my ignorance here, Jim, help me out here. Pacific Gas and
Electric, PG&E,
MPGE,
which I own.
When I was over there in California, actually I was up in Canada at the time. I was in Vancouver, and we were driving down to California, and somebody told me about this stock. And I didn't know an awful lot about them, and I sort of read about them, and I thought, wow, this stock is really underpriced. It looks like a great buy.
Right.
And I'm still not going to say that they're not a bad buy. I think that they've probably been a bit mismanaged, but we won't go into that. But who's to say that they're actually going to turn their problems around? So GE, yes, they've got some issues. Let's talk about a company that is different, but is not too different to a company like GE. Let's talk about Deutsche Bank over in Germany. Now, Deutsche Bank, big bank, top 20, been around for a very, very long time. I don't personally think that the things that have happened at Deutsche are that much more dramatic than what's happened at many other banks. But would you buy Deutsche Bank shares today on the same premise that you've used to justify why GE is a good buy? And I'm not telling you not to buy GE or to sell GE. I'm not telling you either way.
You don't get to give financial advice.
Okay. Wait a sec. You have some kind of a point that obviously you're trying to deliver. What is your point that I'm not catching?
No. There's no particular point that I'm trying to drive home. I'm just simply, I guess what I'm trying to point out is that it becomes very easy for us to sometimes look at a company and believe that because of a company's longevity, or because of a company's size, or because of a number of other reasons, that those companies may come back, or that those companies may perform in a particular way. And I guess if I'm trying to make a point, it would be that a lot of the things that I've heard you talk about are covered calls, okay? And I'm not saying that covered calls are a bad idea. I'm not saying that. However, I'm not sure exactly what goes on in the academic world, but certainly when you are required to get the equivalent of your licensing, for example, here in Australia or in the UK, and my understanding of the US's regulation, Series 9, I think it is over there, you have to sit for very similar kinds of exams and tests. One of the very first strategies that they're going to teach you is going to be covered calls. So what I'm simply saying, I'm not suggesting that covered calls cannot be used in a way that can be profitable, but the two major things that I hear when people trade covered calls is, one, I'm limiting my risk, and two, I'm gaining income from stock that I already want to own. And on both of those points, I personally, not in theory, but in practicality, I personally don't agree with that. And so the point that I'm trying to make is, if you are going to come to a conclusion, whether it be right, wrong, or otherwise, that XYZ company is going to do a particular thing, why wouldn't you just bet on that particular thing happening? Instead of trying to, take a stock, write a call option against it, and you don't even know how to price the call option. So for all you know, the call option that you're selling might be at a really, really low price compared to how options are actually priced. So that's all I'm trying to say, is that the markets are a little bit more complicated than that. And if the very first strategy that they teach in undergraduate in Economics 101 or Trading 101 is covered calls, there's a pretty good chance that that's probably not the best strategy for you to be using.
Probably not, and probably is. Okay.
Let me interrupt just a second, because it's like I'm the referee between two heavyweight fighters right now.
Okay.
And I want to say, kids, don't try this at home. What they're talking about, because they are professionals. So that's my disclaimer. And, so fire away, you start punching again.
Look, let me say this to try and use a chess example, okay? And again, I haven't had particularly great chess coaching. It's just been me at school mucking around, and that's why I've never ascended to your levels, right? I read a book, I saw The King's Gambit, thought that looked cool, started doing it.
It is
now
cool.
I would imagine that most people who are as advanced in chess as you guys are would probably say to a 12 or 13-year-old kid, yeah, do the chess gambit, you're going to win a lot of your games. Sounds really, really good. But that's probably not going to be the thing you're going to teach the 5-year-old who's just learning how to play chess. And it's certainly not going to be the thing that either of you guys would teach me today. If I asked you, hey, can you help me with my opening repertoire? You're probably not going to start off with, hey, learn the chess, the King's Gambit, because it's a dangerous opening.
Well,
right?
so, neither Sasha nor I would allow you to play the King's Gambit.
I'd probably do it just to annoy you, but
you wouldn't have the opportunity.
But and I have a lot of fun. I have a lot of fun with it, just because it's a fun way. But sometimes you play chess not to win or lose. It's for the fun of it. It's for the mucking around. But the point being that the very first move that you might try and teach me, like when I first started to learn how to play chess, right? They would say to me, okay, open up your first two pawns, your queen's pawn, your king's pawn, get your bishops out, get your knights out, get yourself castled, make sure your rooks are connected and your queen's out. Okay, and I being the chess genius that I am, tried to teach a 13-year-old child this a few years ago. And that was exactly move for move, exactly what they did. And they didn't end up with terrible positions, but it wasn't quite the point that I was trying to make. I wasn't trying to get them to open in quite that way. I was just trying to tell them that that's what the opening principles were. Now, the reason I say that to relate that to finance is the very first thing that people learn is covered calls when they're learning about options, because covered calls are really easy to understand and they're really easy to explain. However, there's no way that I'm going to get paid millions and millions of dollars a year to trade other people's money if the very best strategy out there would be for me just to write covered calls. Right, so that's all I'm trying to say, is that there are other strategies that are worth looking at and exploring that may give you one of a couple of things, either the same returns for less risk or a higher potential return for the same risk.
Okay, I have a question, a couple questions. Number one question: if people just don't know nothing about options, they even never heard what options are, and you were able during 2, even 3 sessions to explain something about calls. And the first thing you are trying to explain people how to use and how to do covered calls. Why would you go at the same time to explain, but this is not the only strategy. Oh, you can do also this and that and this and so many things, if they don't even understand fully the concept of covered calls? Why would I do that?
No, perhaps you wouldn't.
Okay,
Perhaps,
agree that.
but
So you're not, you don't
would
have, you, okay, hold on. 2 things. No, wait a moment.
I didn't finish my answer though, Sasha. Hang on 1 second.
Oh, okay, go ahead, please.
I wouldn't teach them what you just said, but perhaps I would teach them a married put instead of a covered call. I can come back to my reason for that later, but perhaps I would teach them the married put before I would teach them the covered call if I was going to do that.
Okay. So basically, my teaching method, you're not criticizing. You're criticizing my trading method, which is entirely different story. Because I can teach one thing, I can teach you how to play King's Gambit, but I myself, I will play Ruy Lopez, for example. But at certain period in your development, you have to learn how to play King's Gambit. And once you become at home, then I'll show you, but you know what, besides playing King's Gambit, there are some other ways of playing opening. Now try Bishop's opening, E4, E5, Bishop C4. Oh, Bishop C4, how come? Oh, yes, because you're threatening potential checkmate or so on. Then you will show eventually the defenses against Bishop C4 and say, well, you know, look, Bishop C4 doesn't do much. Okay, why don't you try maybe Knight F3, a better move? So the same thing here. So you understand where I'm coming from regarding my teaching method. However, now you are questioning my trading method. And what you are trying to say that instead of doing covered call on General Electric, I could have done Mary Poo. So in the way to sell, stop was say 6.95, so I could sell 5.95, 5.90 or $5 or 4.75 puts. And if the stock would go that low, I would get the stock at 4.75 plus premium for put that I got and so on. It's so wonderful in theory. In practice, we're dealing with this way. Number one, let's say stock ran from $6 where it was, $6.95. It ran all the way to $8, $9. I'm not there. I collected some money for premiums for a put, which is wonderful, but I don't have the stock. The stock is going maybe to $35. Not now, but the next probably 25 years, it will be $35, but I'm not going to be there anymore. Okay, now we are talking about another proposition. In order for me to sell put, I have to put 50% of the margin requirements that would allow me even to consider to sell put. However, if I'm buying stock, I have to put only 25% margin requirement. So my capital requirement in case of covered call are twice allow me to have more capital available for other positions than to commit them to the married food.
Let me. You've said a few things.
That's not all. That's not all.
Yeah, but you've made a couple of you've just made a couple of slight errors there. I just want to very quickly correct.
Okay, fine.
Firstly, I'm not criticizing either what you were teaching or your teaching method. I'm simply trying to point out that there are actually other types of things that should be considered. But just leaving that aside, you made a point there about the amount of margin required for a put option versus a call option with stock. A married put is where you buy the stock and you buy a put to protect the downside of the stock. So your margin requirement should not be any higher than a covered call. Also, please remember that whatever margin requirement you might have is going to be different depending on who you are, how much money you have, what country you're in, and the rules of your individual broker.
I agree.
So a trade structure that might work for you might be totally different for me.
I agree. Okay, couple of things. This is completely different proposition, what you just said, to buy stock and to sell puts. This is
to buy puts. And buy puts.
But I already told you that the sellers of options beat buyers every single year from the inception of trading in 1973 until today, except 1987. Why would I even consider to buy options? I can buy options. I've done it many times before. But if I teach people and I want to explain them, how can I suggest them do something what only 1 year ever people win? I know what you're trying to tell me, that people are hedging, and even if they lost money, but it's part of their overall strategy. So that's all. Well, I don't care what other people are doing. I don't care. I don't care even zero about all the professionals. You see,
we had a 2-hour conversation about this yesterday privately.
Correct.
Okay, let me use a different example for you then. That would I believe highlight my point in a better way.
Please do.
Okay. All right. I take it that in the United States you have insurance companies that insure motor vehicles. I would hope so, because I think you guys invented that sort of stuff. So you have insurance companies that insure your car. You buy a $50,000 car, your insurance policy is $1,000 a year. Okay? Now, if you were to go and have a look at every single person that bought an insurance policy versus how many of those people got paid out more than what they paid for their insurance policy, for their 12-month insurance policy, you would probably find, if you were to study that from an actuarial perspective, you will probably find a similar statistic, that the vast majority of the years, the insurance companies made money doing it, okay, and the people being insured lost money doing it. Based on that logic, you would say to somebody, listen, your next door neighbor is driving a $50,000 Cadillac. Now, if you were to sell them an insurance company, instead of them going through, I don't know who your big insurance companies over there, Geico or whoever your big insurance companies are in America, right? I don't know them. They've got that lizard thing. Right? That's the only reason why I know them. So instead of going through the big insurance company, right, tell your neighbor that you will insure their car for them, right? Because every year for the last 30 years, except for one, you'd make money doing that. That's the logic that you're applying to the finance markets. What I'm saying to you is you are correct in what you've said. You are absolutely correct in what you've said. But these are some of the misconceptions that are told to retail traders all the time. And I know, because I used to be a retail dealer, what you guys would call a retail broker, right? I used to deal with retail clients all day, every day. And some of the times I used to believe this myself. It wasn't until I started to get more into the institutional side of banking and finance that I started to look at things and go, this doesn't make any sense, okay? They're teaching you this stuff for a reason. It's the same reason why if you go to Vegas and you go and play roulette, they put the big flashing board that tells you what all the previous numbers are, right? It's the same reason. They're teaching you this stuff because it doesn't work in reality, in practicality. It's very easy to look back at numbers and say, this works when you look at the numbers. If you look at the numbers, yes, the vast majority of options expire worthless. Why? Because the vast majority of option holders aren't going to bother selling options at very low prices if they've already made their profits elsewhere on the trade. We talked about that before when I said if you happen to buy a protective put against your stock, which, by the way, is the reason why options volatility, which is the way options are priced, go up so substantially in theory. It's because pension fund managers and hedge fund managers are often mandated to own stock. So the only way they can protect themselves when there's downside volatility is to buy options, which increases their price. Once that situation is over, there may not be a point in selling the option. They may as well just keep it and let it expire worthless. That does not necessarily mean that just blanket selling options is going to be a profitable strategy. Sorry, Darren.
Let me say a couple of things. That you've made two errors, and I want to point out, to become a retail trader, you pass the Series 7, not Series 9. And the other very serious error that you made was you said X, Y, and Z. And we say, in America, we say X, Y, Z. If you want to move to America, you get that.
I am closer to the country that invented that language.
I know. I agree. I know. And X, Y, Z is superior, but it's not American.
But quite seriously, is it Series 7? Not Series 9? What's Series 9?
Well, Series 7 was what we needed to have to trade, to be a retail trader.
Well, because the last time, because I had to just check this recently in order to find out whether or not I could have US-based clients within my institutional fund, and they were telling me about Series 63 and Series 65, and I said,
all sorts of things.
The lawyer will come in and help you.
Okay.
Gentlemen,
I object.
Since
Judge,
we do manage about $500 million in pension funds at my other company in Salt Lake, which is around $500 million, and my partner is an OSJ, which means he passes a Series 26, and he runs what they call an office super. The series to trade individual stocks is Series 7. Mutual funds is Series 6, and I used to be Series 6 and 63 licensed. License for options is Series 3. So the thing is, if you want to do what Sasha is doing professionally, you would need to have a Series 3 license if you're going to do it for other people. Now, and of course, I've been listening backstage to all the strategies or tactics on General Electric. But as a value investor, because I have played that, but I haven't played General Electric yet. It was on my watch list. And so I did some research on, and part of the reasons on my watch list, I look at the 52-week high, low, and company valuations, because we value companies all the time. Well, one time, and I told Sasha, this was a stock valued at $30 a share in the last 5 years, now sinking to $6. What happened? In other words, within a short period of time, how could a company lose that much value? And of course, Jeffrey Elmalt, who took over from Jack Welch, basically sucked money out of the corporation. Why the $168 million in his pocket? Why the board of directors stood around going, I don't know what's going on. And of course, there's a lawsuit involved, about this because the shareholders are a little PO'd. And that's where lawyers make money, because we're going like, dude, you kind of messed up our friends here at General Electric. But again, as we sit today, the real question, and this is where the is it a buy right now? Because now we're sitting at around $7 a share. And this is the reason it's on my watch list. And when Sasha brought up about it, I look at the 52-week high low, and it's on the low side of it. And I always like to buy. I don't know about you. I like to buy low, Shaquille, and I like to sell high. It's just been the nature of how I do business. I don't know about Sasha. He likes to sell.
This is so terrible, Nick. But before I do, because I just have to say this before I do. Jim, back me up here, okay? Back me up here. We all know Nick outside of ibmtv on another platform that you all communicate on, where I see his other business interests, and I think, my goodness, he's in finance and he's a lawyer. Is there any reason that we like this man? Is there any reason at all? Is there any redeeming?
I'm running for election here.
He lost a lawyer.
And he's a 3-time Florida state champion, and he didn't even offer me any chess lessons. This is terrible.
I barely talked to the guy.
The thing is, I'm just looking because I parked a lot of money in cash. So when Sasha came on earlier about parking cash, I'm wet over there. I've got like lots of it sitting over there. And part of it is because I don't believe in the valuation of the market as it sits today. And I talked to my business partner about, hey, what are we going to do with all this cash? We're wet, and if you're too wet today, you drown because you're not making anything really. It's sitting there the money isn't working. It's sitting there.
I would guess you're actually losing if you're sitting on cash.
Oh yeah, definitely. But yours truly, who has been through the crash of 2008, watched the market go down so fast. You took a roller coaster ride in a bath. I mean, it was absolutely horrible. Now, by that time, I think we had 300 corporations who were working on their plans, mainly parked in cash. At that time, that happened in 2008. So we were up 4.5 that time. And it didn't really affect our business, but it affected their businesses tremendously, but not their plans, because we had them parked there. And so now I'm sitting there looking like, okay, we're parked. When's this crash going to happen? And of course, they're manipulating it here by throwing cash into the economy. And so it's artificially been inflated. Okay, and when you get these reports, 1/3 of mortgages here in the United States aren't being paid. Okay, that's not a good report to get, Shaquille, to sit there and lovey-dovey and be in the market space.
Now, sorry, I have to interrupt you there again, because this is one of those things that I have to say again. It was something actually I meant to touch on this on Monday night, but I didn't quite get there. Okay, 1/3 of mortgages not being paid across the United States sounds really bad.
Yeah,
no, that sounds bad.
Show me where that's good.
Okay, show you where it's good. Okay, well, and I don't know because I haven't looked at the numbers, but
40 million people out of work on top of it.
Okay, so that sounds pretty bad. That sounds pretty bad, sure.
Yeah, it does.
But you have to compare something to something, right?
Sure.
You have to compare something to something. Now, especially you, Nick, because you've been in finance for a while, you are well aware of the pairs trading.
Only 37 years.
Right. So you're well aware of some of the pairs trading type techniques that were developed by Morgan Stanley back in the day. So let's just compare. If you say that 30% of mortgages aren't being paid in the United States, and that's doom and gloom, and that's terrible. Okay, cool. What's the rate in Canada? I have no idea, by the way. What their rates are. But let's just say the rates in Canada are 40%, just as an example, just making it up. Okay. Well, let's say the rate in Canada is that 40% of mortgages aren't being paid, and in the US, 30% aren't being paid. Mm-hmm. What is the better bet? I'm better off betting on the United States than betting on Canada if those are the cases. And of course, if the reverse is true, where in Canada only 20% isn't being paid and the US is 30%. So my point being is you've got to compare, something against something. This was one of the major things that I observed as a foreigner who didn't live in the United States. Well, I've never lived in the United States, but as somebody who wasn't in the United States during the Great Recession. Because when I wasn't there, anytime you turned on US media and US news, it was always about how calamitous the event was within the United States. But they never compared and contrasted what was happening in the United States versus other countries. Ireland had it pretty bad compared to the United States during the time that the United States was in a really bad position. So it would make sense to perhaps lower your exposure to Ireland and increase your exposure to the United States, even if you think the United States is not performing particularly well. And the same
United States.
Yeah, we're the world's largest economy, Shaquille. I mean, we're 23% of all the GDP. What's Ireland? Ireland doesn't even amount to one of our tiny little states. Why would we care about Ireland?
But hang on a second. Who cares that you're 23? Let's say that the United States is 90% of the world's economy. Who cares? You personally, even if you are the largest hedge fund manager, pension fund, even if you're Vanguard or BlackRock,
right?
Okay, the percentage of the US economy that you represent is minuscule. So who cares how big the US economy is when you're talking about, when Sasha's talking about buying a few shares in GE, the few shares that he's going to buy is going to have absolutely no movement, no change whatsoever, and no influence.
Except on Sasha's account. Then it will have an effect.
On his account, it might.
Yeah.
But on the overall market, it's not.
Yeah, but he doesn't care about the market. He cares about what goes on.
I want to tell you something.
But you know what I mean? Those things aren't going to make that big a difference.
Okay, but
it's Sasha show. Let him talk.
Yeah, may I tell you something? Please do not underestimate the Ireland, because in 60s, Ireland declared the war against Soviet Union. They said that it's a godless country, the communists, they're lying there. So they declared the war. So Brezhnev, at the time General Secretary of Russia, Brezhnev called the Irish Premier Minister and asked, well, I've just been informed that you declared the war against the Soviet Union. May I ask you, how many tanks do you have? So he said, well, I have 65 tanks. So Brezhnev says, we have 12,500 tanks. How many warplanes do you have? Well, we have 87 warplanes. Brezhnev says, we have 25,000 warplanes. There was a silence. And then Prime Minister says, the war is cancelled.
That's called Mickey P.
Yeah, so I agree with you. What Sasha does relative to the market isn't big. But when I look at General Electric, I look at maybe as a value investor. In other words, as a long term. He's looking to get in and out by November. I look to get in and out by November, maybe in 2028, is a whole different story.
Why not buy Enron stock?
Because I have a real story with Enron stock. One of my clients had $17 million of Enron stock. And he came to me and said, okay, what should I do? And I said, well, what else do you have in your portfolio? Well, that's it. I've been doing really well with Enron stock. I said, here's what you need to do. Sell half, keep half. Where'd you come up with that? Well, I have several clients. One client founded Dunkin' Donuts. One client was the founder of Coca-Cola, his founding family. The other was the president of Kimberly-Clark. The other was the president of Bausch & Lomb. The other was the president of Philip Morris. And you run into these decisions when you're working with them, and they say, well, what do you do? Well, it's always sell half, keep half. Why? Because you don't want to keep all your eggs in one basket. And he refused to do it. He goes, hey, I made my fortune. And what do you know? I've got $17 million in one stock. I'm doing good. He lost everything. He's broke. Seriously. And I can tell you story after story because I've advised you.
It was an interesting thing that I picked up on the other day, Nick. Look, obviously I can talk a little bit about economics. I can talk very badly about chess. There's a few different things that I can talk about. But when it comes to regulations and things like that, look, I'm not a big fan of government regulation, but I'm often fascinated by some of the things that I hear. And something that you mentioned on Monday about pension funds, yeah. I've never fully understood pension funds and the arrangements in the United States. Yeah. You hear about these sort of stories, especially the cowboys of the 1980s,
right?
Where they would buy companies and strip the pension fund money out,
yeah, right.
And then pull these people out of work.
Right.
And for me, because I grew up in the 80s, for me, like learning about this sort of in the 90s as a teenager and the early 2000s,
Mhm.
I kind of went, like, how do you do that? That doesn't work. That money doesn't belong to you. And I was actually really fascinated to hear both what you said the other day and also, fairly recently, that if I set up a company, Shaquille Incorporated,
Right.
set myself up in Delaware,
Yep.
I can have all of my employees' pension funds invested in my own stock. And I sell the company and things like that. I know the rules are probably a little bit different now, but that sort of thing, that sounds really, really bad. And I think that's something that, as much as I'm against government regulation, I certainly think that's something that needs to be improved.
Well, the thing is the pension fund rules have changed a lot over the last several decades, and they change all the time. But part of it is to protect the pension people who are benefiting from it. Part of it is our government agency called the Pension Benefit Guarantee Corporation to make sure people receive their benefits. So, and then the structure of funding has all changed. Actually, changed in 2006 with PPA 2006. So it's today a pretty heavily regulated industry, mainly because of what you just said. It was kind of the wild west, and individuals could raid the funds for their own pecuniary benefits when they're technically the benefits of all the employees that are working for that. We don't see too much of the problems that you would read about years ago because of the security. Part of the reason I can't get my business partner on, he goes, well, I'm a Series 2663, and everything I say is regulated by the Securities Exchange Commission and FINRA, the Financial Institution Regulatory Authority. Now, why can get me on? I'm not securities licensed. I'm not FINRA licensed, and I don't do any of the trades or anything anymore. All I do, I have very simple jobs, Shaquille. I own companies and I don't do anything, and I like that, the latter part. Okay, and that's it.
But Nick, there's a big problem with over-regulation. There's a very big problem with that. Now let me give you an example. I might be wrong, Sasha, so please forgive me if I am. I've been trading options for the majority of my professional career, because I fell in love with them. I love the versatility of them. I started to learn how to use them in different ways. You often hear me talk about options volatility. That's something that I haven't and will not have time to expand on today. But options volatility, once I learned it, made a significant difference to the way that I looked at the markets, the way that I traded, and the profitability that I had. Okay, that made a huge difference. And that's why I can talk about covered calls, barrier puts, and all the other strategies, iron condors, butterflies, all the other things that we can talk about. I can talk about them with a lot more authority than I used to be able to, because I understand options a little bit differently. That being said, there is nothing right now to stop Alexander Sasha from saying to me, I am going to charge you $10,000 right now, and I'm going to turn you from a 1700 a chess player into a grandmaster, 2700 grandmaster in 3 months, right? Now,
if you buy that, buddy.
Right, if I buy that now, if I buy that, I buy that. If I don't, I don't. But it's up to me, is it not? Yes. Should it not ultimately be my choice? If you and Jim both say to me, Shaquille, that's an impossibility, that's never going to work, you should not do that with your money, okay? And I say, look, it's my money, 10 grand is chump change for me. Whatever he does teach me, I think will improve my game, so I'm going to give him the 10,000. Surely I should have the right to do that. But what we see in the finance industry is that I could go to you, Nick, who is very, very experienced, and say, Nick, I have this particular financial plan. I think this is an amazing idea. It's really great. And I could get in trouble for it. Whether I can from over here in Australia, I'm not exactly sure the international law on that. But if I came to the United States and made a proposition to you, I could get in trouble for that without having the right licensing. Right. Now, what does that actually mean in reality?
Okay, what it does in reality, we don't have a lot of time on this, because back in 1984, it was, or 85, was my first lawsuit against a company that did what they call a Ponzi scheme. Elliott Securities in Naples, Florida, Ponzi'd about 50 million. What you find out, remember, financial sector is big in the United States, about 25% of our GDP. It's not small at all. We have pension funds where I work in, 20 plus trillion, not billion, $trillion. Okay, and what it does, it attracts three people: conmen, artisans, and thieves, because a lot of money is floating around in this area. Jim's going down. Let me tell you something. We could do a whole day on Ponzi schemes. I mean, seriously.
It pushes people away, Nick, and that was the thing that I wanted to put to you. It pushes people away because, recently, obviously, as I said to you guys the other day, I have a fund structure that I've almost finished completing in Liechtenstein, which is predominantly Switzerland, Swiss based, and I have another one in Singapore.
Right.
Okay. Now, the predominant place where funds are domiciled in the world, especially to cater to US investors, is going to be the Cayman Islands.
Right.
And the reason they do that is because it allows them to adhere to regulations under the AIFMD rules for the European Union, as well as adhering to US-based rules. All that does is exclude the majority of the population from being able to invest with people that really know what they're doing. And so for somebody like myself, if you guys will be gratuitous enough to assume that I'm talented, what that does is it means for somebody like myself, why would I bother jumping through all the hoops that I would need to jump through to become regulated in the United States, a country that I don't live in, just in order to attract some retail and mid-level institutional money from US investors, when I can set up offshore and never have to worry about it again?
Yeah, well, no, you could do that. By the way, the Cayman Islands, I've been there several times. I have stories about that. A guy named John Matheson, who set up the Guardian Bank there, who turned out basically to do tax evasion and had some serious issues, and they shut down his bloody bank there. Okay, the Cayman Islands is a place, but here's some of the rules that happens with the foreign investors. Let's say you have a mutual fund in the Cayman Islands or any place. You cannot advertise that here in the United States. In other words, they limit you tremendously because you're not subject to the SEC or FINRA jurisdiction. In other words, we don't know if you're just another bloody Ponzi scheme or not. So if you want to play by the rules of the world's largest economy, you got to set up your operation in the world's largest economy.
No, you have to. All I've got to do
they have to go out offshore. The client has to go offshore looking for you. And
all I'll have to do, I assume you're in California. All I have to do
in Raleigh, Durham, North Carolina.
You're in North Carolina.
Right.
Okay, well, I love North Carolina, and I like Raleigh as well, so I spent a lot of time there, over there. So I show up over there in NC and say, Nick, let's go down to the bar, okay?
Right.
We go down, we have a beer, and I tell you about this U-Butte plan that I've got, this amazing plan that I've got. I didn't advertise, I didn't solicit, and good luck to you if you try and prove that I did.
Right. Okay.
Right? That's the way.
There's what they call scofflaw. Yeah, you could what they call scofflaw the whole thing, as they would say, but the correct procedure, and my other partner actually handled our international legal area. The correct procedure, if you want the American to invest in your funds, is you offer them, or you don't offer them. You let them know about a conference you're doing in the Bahamas. Conference, okay. Yeah. I'm serious. We're doing the and he did a lot with BFI, was the name of it, in Nassau in the Bahamas. BFI, International Tax Planning and Investing Conference. The Americans fly, it's cheap flight over to the Bahamas or Caymans, and then they go to the bloody conferences. Now you're playing under Bahamian or Cayman Island law. All bets are off. If they invest, fine. If they don't, fine. You're outside the jurisdiction of the United States. Okay, so that is how a lot of the international money managers set up their shop.
And that's my point. I'm 36 years old, right? It's not like I'm 50. It's not like I've been managing, hundreds of billions or tens of billions of dollars worth of funds. Right. Okay, I've managed to manage a few billion, and I've done reasonably well. Okay, but if I wanted to take what would seem to be the next logical step, right, which would be to go across the United States, Okay. Why would I do that? It's a really bad move.
No. This is you have a point. This is a very tough market.
And this is the same issue that a lot of Europe has actually as well.
Sure.
And so what you end up with is and Australia has the same issue. So what you end up with is an industry that only has charlatans and conmen and salespeople that want to get great.
They actually eliminate a lot of them because of the securities licensing and Form ADV. What happens is most of those people were drummed out of the business. So over the last, remember, 37 years ago, this is kind of the wild, wild west. 37 years later, the Form ADV and the FINRA compliance has basically gotten rid of almost all those conmen artisans and thieves. So usually the financial advisor, not all the time, but generally you're running a pretty clean ship, or your ship is sunken by the SEC a long time ago. You won't see those guys again. They're gone. But for you coming in from a foreign country and you're not going to register your securities in the United States or your fund, best step is to stop at the Bahamas, because Florida is where I'm really from. It was a quick flight over the Bahamas.
Oh no, I am going to register if I do come to the United States, which I think is inevitable because you guys have this.
We are the world's largest economy.
Well, that's not that big an issue too, but you have this terrible habit of sucking up all the talent from around the world. So I will head on over there, and the Californian weather is quite nice. Although
they have 40% of all venture funds.
I do quite like North Carolina, but look, I will probably go over there, and if I do, of course, I will comply. But all I'm saying is that when you have, we've got a globalized world today, and I think we need to see some stability across regulations, but also something that we need to see, to get back to Sasha, whose show it actually is.
And we're co-opting this show.
What I think would be really important is that people start to actually learn how options and how other derivatives actually work. Right. And how they're actually being used, both for and against you, so that you can make informed decisions. Right. Because, Sasha, if you ever wanted to make an argument against my point, clearly I'm pretty against covered calls under most circumstances. There is a thing called the S&P.
My friend, I cannot argue your points because I don't understand what is your point. And if I don't understand that, how I can ask any question? I will let you talk for the next 3.5 hours. I have no problem with that. The problem is
Sasha just likes going to the bank with his covered call writing.
I need lunch. I need to have lunch.
If the point that I wanted to make was that writing covered calls is not a long-term successful strategy, and you wanted to argue against that,
my friend.
I'm giving you a counter argument to
that's the only available strategy. I just wanted to explain. Whoever listens to me, I even don't know. Maybe they know about calls and puts much more than two of us together, and Nick including. I don't know that. But if I have some people in mind, and I know that they're listening to my show, and they wanted to get a little bit more advanced, especially now that the fixed income pays you 1% a year. What to do? I mean, I'm asking myself.
Sure.
I mean, what to do?
I just want to very quickly say this. I know both of you had your hands up. Let me just very quickly say this. If there was to be a counter argument to my objection to writing covered calls against stocks, there is actually an index, an ETF, I believe it is, called the S&P 500 Buy Right Index. And all it does is it buys the S&P 500 underlying instruments, and it writes call options against it. And almost every year, that index has outperformed the market. Yes. So I'm not saying that you can't use these instruments. I'm simply saying that there are much more advanced ways of using the instruments, and it's really important that people learn how to do it. One of the biggest things I'd like to...
How they can learn more advanced instruments? Just explain to me. How? They don't know covered calls. They cannot use
By the way, Sasha does have a point. They don't even know covered calls in the United States, let alone
how ignorant we are.
Yeah. But Sasha, how do you become a more advanced chess player if you don't even know the King's Gambit? Look, the more important answer to your question is this, okay? if you're doing covered calls, the main thing, this is one of the biggest objections I have to covered calls, is that the main two things that people will tell you about covered calls is, one, it lowers your risk, and two, it gives you income. They're the two biggest things that people say about covered calls. Now, if you are to buy options, you may well be correct. Okay, I don't agree with you. I know that the statistics are correct in what you've said. I just don't agree with you that you are, but you are right. Every year except for 1987, options buyers have lost money versus option sellers. That is statistically and theoretically correct. I just don't think in the practical world that's correct. However, and we had an
That's brilliant. What you just said is brilliant.
We can just
anything so brilliant as you just said.
I'm happy to have another discussion about that. But the point that I want to make to you about that is this: let's just assume that even what you're saying is correct. That doesn't mean that every single person that sells an option is going to make money. The big problem is when you sell an option, okay, and you might be margined differently depending on who your broker is or whatever. But when you sell an option, you are exposed, whether it's a call or a put, you are exposed to unlimited risk in both directions.
I'm talking about covered call only. I'm talking covered call only.
Sure. Okay, hang on. Now, you say covered call only means that I am at less risk because I have the premium there to protect me against a downside move. And I said to you yesterday, why not do exactly the same thing? Why not just sell the put? Now, forget about margining.
Several times. I'll try one more time.
Forget about margining, because that's not an excuse.
No, it's very important because my margin is 50% and the covered calls 25%. Number one.
Okay, let's say that I have the same margining. Would you have the same excuse?
Okay, maybe for professionals, maybe it's not important consideration because they're operating with hundreds of millions of dollars.
No. There are other brokers. There are other brokers that on a $5,000 or $10,000 account will give you the same margin. You put up 50% of the value of the stock. You can write a put option. It's the same payoff diagram. Why not do one versus the other?
Okay, I'm not talking about $5,000 account. It's like somebody asked me what. Okay, he wanted to get advice how to invest $100 for his niece, and I said to buy ice cream. Okay. We have, let's see, 6-7 figures account, personal account. I don't have to report to anybody. I don't have to please anybody. Nobody will tell me, hey, you are fool. You just made 20% return. And here's a guy sitting right next to you. He's made 22.5%. You're fired. I don't have that. I can do as I'm pleased. I can generate.
Shaquille, if I may,
30%.
Tell you what Sasha's point is Sasha's trying to teach me algebra and you're talking calculus.
Right. I mean, seriously, the thing is, because there's different levels of investing, and in the United States, the investment knowledge and levels are actually pretty low because they don't teach options. My first options I was bought in the options in 1987, which Sasha just told me was the only year that they won. So I got lucky, got out in 87. I haven't been back since, but now he told me that was a good thing to do. And I made money in buying options in 1987. That was right after the market crash. Because like I said, I buy at the low, sell at the high. So I was buying options at the end of 87, selling out, and haven't gone back since. And so the thing is, but here's the real problem, which is what Sasha's saying. Okay, you know how to play the King's Gambit. Most of the people out there haven't even read Chess for Dummies. That's the problem.
Neither have I. I've been trying to find the book, actually.
They haven't even read that. Okay, King's Gambit. Hey, Shaquille, you're like light years above them with the King's Gambit. Okay, so when Sasha's talking about options, most of the people listening don't have a bloody clue and never bought an option before or do a covered call writing. You're looking at being very basic. You're going, hey, come on, that's the King's Gambit. A lot of the viewers are looking at like covered call writing. First I ever heard of it.
But Nick, but that's the reason why I have such a problem with it, right. Because people who are just starting out are learning to to sell covered calls, right?
Yeah.
Selling a call option, let's just say you made a mistake, okay?
Yeah.
And you sold the call option, and without realizing it, you sold the call option naked because you thought you sold the call over ABC, and it was actually
I'm talking about covered calls. How can you sell naked option if we're discussing covered call only?
He's just doing a covered call.
Alex,
He's not buying a naked option.
All which is covered.
I bought naked options.
We were getting to naked options last show. But
Sasha, I'm trying to give you an example to highlight my point. Now, you may not agree with me, and that's okay. Okay, but let's leave the example that I'm trying to use alone. The point that I'm trying to make is this: buying an option gives you limited risk with potentially unlimited profit.
Correct. That's the reason I bought in 87.
And that's what he did in 1987.
That's what I did in 87. I totally agree with you. I remember the play.
let him finish his comment.
Yeah, I like that. I like options.
Alexander, you're correct. In 1987, but the fact still remains: when you buy an option, your risk is limited to what you paid.
Correct.
When you sell an option, your risk is unlimited. Now, I know what you're saying.
Let him finish, Sasha.
Okay, I'm trying to limit. See, my first rule is preservation of capital.
Second rule.
My second rule and my third rule. How buying options can fit in this idea of preserving the capital? I just don't get it. Maybe I'm not advanced enough. Maybe I'm stupid. But I just don't get it.
Right, okay, Alex. Let's play it your way then. Let's play it your way. Nick says to me, "Hey, great idea. Let's buy low, sell high." I've got a really good idea as well. Let's play chess this way. Let's make sure that we always win and never lose. I mean, this is ridiculous. This is a kind of logic that is always used by people, right? But you want to beat the market, buy low, sell high. What's high right now? What's low? I've got no idea. Neither does anybody else. But let's say that all you ever did was to sell options. Let's say that you inherited a portfolio from, some great aunt, and they gave you every single stock in the S&P 500, and it was worth $100 million, okay, in equal amounts to what the S&P 500 is, okay? And you could only choose one strategy that you could use for the rest of your life. That was it. You could only do one strategy. And the strategy that you chose to use was to sell call options against the stocks, okay? That was the only thing that you could ever do. What do you think would happen in 20 years, 50 years, or 100 years from now? What would happen is all of the stocks that outperformed the market would have been called away from you, and all of the stocks that were losers is what is going to be left in your portfolio. Now, that doesn't sound to me to be capital preservation, okay? Nor does it sound to me to be one of the other nonsense things that you hear from traders, such as cut your losses short and let your winners run. If you sell covered calls, my concern is, I'm not saying they can't work, they can. I trade them myself from time to time. My concern is that to use them as a blanket rule, okay, will often mean that you will miss out on profits that you should have had while still having taken on the risk to justify those profits.
In yesterday's, we talked, and day before yesterday and today for an hour and a half. At what point when I said that that's the only strategies that I would use and nothing else? At what point? It's all recorded. You can.
No. You never said that. But a few minutes ago, you said that.
Sorry?
You never said that. But a few moments ago, you said, "What about our viewers who don't even know what covered calls are?" Right.
Okay.
And that's what I'm addressing.
Your point is that because covered call cannot cover all investment ideas, propositions, situations, and so on, I shouldn't even discuss it with listeners, and just what then I should discuss. As we know, both of us, and Nick knows, and Jim as well, there is no single strategy in the market that works always, at any time, all the time.
True.
There is no single strategy.
Yeah, remember Dogs of the Dow?
For us, we always have to look at what's happening in the market. I always have in my mind that the next 45 seconds market can drop 5,000 points on a Dow. I always have that scenario. I'm always ready for that. So covered call, yeah, most likely you will make some money. Most likely it will help you. If okay, you see, your example is different. Let's say you inherited a bundle of stocks, which is make it S&P 500 or so. You don't know are the market is moving down or its direction is up or it stays the same. You don't know even what strategy you are going to use. I don't say that I would start immediately selling covered calls because I would just have to understand and comprehend where we are. Now, what I'm using as a cover call strategy is a selection of a stock with a very low risk inherited, like General Electric, which I bought at the point when I saw that my stock downside is limited maybe dollar maximum $1.50. So from $6.95, I figured out that $4.50 it cannot go below $4.50. So I got premium $7 from selling coal. So now my downside is only 43 cents. So, okay, how can I stomach the 43 cents loss? I don't really want to take a loss, but if this calls will expire, then I can sell further calls, at least covering 43 cents. So I figured out, okay, if I will keep all this premium stock, will go down to $4.50 or so, and I will sell further calls now, not November, but probably January. So I figured out very, very negative scenario for my trade, and I accept that I'm ready to take this scenario and still survive. I'm not going to make money. I will make, probably it will take several months, and I hate this position that I have to defend or so. I really hate it. I might rather even take a loss once. My rule is never wait until it's over 7%. So I'm prepared to take 7% loss on any position. Right away, just close it and move into something else where I have potential profits, 20%, 50%.
You know, guys, I hear you agreeing more than disagreeing, actually. And, you know, I did write another book called Chess Openings for Dummies, and I cover the King's Gambit, rather, but I cover a lot of other openings. And so you're both saying that you can have one strategy, but one will never be enough.
I will definitely buy the King's Gambit for Dummies. I will definitely buy that from you. Alexander, look, let me apologize if I gave you, all the viewers, the impression that I was suggesting that covered calls should not be talked about. Covered calls are a strategy that can work very well. They can work very well, especially in times when people have already got stocks in their portfolio. They may have inherited stock because they've worked at a company for a long period of time and stock was part of their remuneration. There are a number of times when writing covered calls can work, and I still professionally, not just in my own personal account, but professionally, will use covered calls from time to time in order to enhance returns. All the main point I was just trying to say was that when covered calls are explained to people, they are often explained as being less risky and as being something that brings in income. And I believe that the underlying premise behind that is factually incorrect. The reason I say that is I don't think it's less risky, because the share price, if it was to drop to zero, is only buffered by the premium that you receive for having sold the call. Absolutely. The profit that you could potentially make is limited by the strike price off the call, whilst having taken a similar level of risk. And I think that skews the risk-reward ratio against you. That doesn't mean that you shouldn't do it, but I'm simply saying that when you do look at that strategy as being something that you want to do in a particular time and in a particular market circumstance, then you need to be very careful and you need to assess whether that is exactly the strategy that you wanted to use. Okay. If I give you a classic example, a few weeks ago, 5-6 weeks ago, when Hertz filed for bankruptcy, I took on a very long-term married put position on that trade, and I made 220% on that position not on my account, but on that position, right, in like 2.5 weeks. Had you have simply bought the stock, you'd have been up 900%, I think it was in 10 days, right? So you would have definitely outperformed me. But I took on a position that I was happy with.
Right.
If you, on the other hand, had said, I think that Hertz is probably going to recover from this, so I'm going to buy Hertz at this relatively low price and then sell a call against it, you would have made the least highest return out of those three strategies. That was the only point I'm trying to make. I know that covered calls can work, and they're a really great starting point for people who are first learning options. But there are a lot more strategies out there that can give you better returns. And one of the things that you talked about, Sasha, was, of course, spread trades. And I would say that unless there's a reason for you owning the stock where you're going to get dividends or some other benefit, why would you not just do bull call spreads, right? Or bull put spreads instead of doing
if people don't understand what is a covered call, how you can explain spreads and bullish spreads and bearish spreads.
Well, that should be the subject of maybe next week's investment class.
But I do have two things, Shaquille. Two things to say.
I think that the first thing that most people want to understand before you even talk about options is what is a share.
Yeah, it's good.
And I'm being quite serious.
I'm
being absolutely serious.
Yeah,
because there's so many people out there that say, I just bought shares in Microsoft, so therefore one brick in that Microsoft building belongs to me.
Right.
People have no idea what a share is. Start with that before we start talking about options.
Well, maybe in my first program I spoke a little bit about shares, but okay, I have a little bit higher opinion of our listeners about that, but maybe you're right. Who knows?
Well, also, we didn't discuss the fundamentals of General Electric. While you guys were all doing that, my next step is always to go, what are the fundamentals of the company? Because
Sasha told me don't bother with that.
Well, I know he says, but I do, because I go, I look to hold for longer than he does, but I also get out. I have a strike price to get out, and it's hurt me and helps me. I usually say, well, once I make 20% on a share, I sell it. Okay, because sometimes in a short period of time, I'll make 20%. I go, how can this company be worth 20% more than it was the time I bought it 3 months later? It doesn't make any sense to me. So I sell it, make money, and I go on to the next deal. But
I did that with Tesla, and I'm still regretting it.
Yeah, that's the whole point. And I did that with Apple, and I'm regretting that too, by the way. Okay, so the thing is, that's.
Can I put my hand up and right. For you Californians, Nick? I know you're not a Californian, but I'm just going to pretend that you are. For you Californians out there, you will all laugh at me because I never, ever, ever could get my head around techs. And you know, I'm born in '83, so I should know like the techs should not scare me at all. Yeah. And I was so resistant to Facebook, so resistant to the only tech companies I ever bought was actually IBM. That was the only stock I ever bought because I couldn't understand any of the others. Google.
A lot of money with IBM.
Yeah, if you look at the fundamentals.
I waited until they panic sold it, and then I bought it.
Yeah, I bought Apple at $99 a share several years ago, and I was going, great deal. It quickly bumped to like $1.20, and I was going, really? So I cashed it all out, not realizing it was still going up. Yeah, but I walked away and went to another
with Tesla
position. Yeah. I know, and so the thing is, I shake my head when I see evaluations.
Two thoughts. Sure. One is that to play the King's Gambit, you play 1E4, and if I don't play 1E5,
you don't play the King's Gambit.
So that's my first point. And my second point
is King's Gambit denied. So I'm actually saying I like to play King's Gambit, not King's Gambit denied.
No, what he's saying is,
did you want me to write the book King's Gambit for Dummies? Is that what you wanted me to do?
No, he writes chess openings for dummies. I didn't know he wrote another book.
But you got to E4, E5 is a must, and you can't always expect people to play.
Well, we should do finances for dummies. Start with covered call writing.
And the other thing I wanted to say is, if you do come to America, go to LA and get the best table at a restaurant by just saying and make the reservation under Shaquille. You'll be golden until you show up.
I've actually I'm lucky enough to have one of your famous American Express black cards, which apparently are a lot harder to get in America than they are in Australia. So getting the top tables and restaurants in LA haven't been a problem. They may have thought I was a bit shorter than they were expecting. I'm 6'1", you know, but
Yeah,
I haven't had a bad time in LA.
But Shaquille will get you in a lot of doors until you show up.
I'll get a hold of Shaquille, get him on the TV program.
There you go.
There you go. I'll drop.
Okay.
My first stop back in the United States actually is I've got to come in, of course, through California because I've got family in Vancouver. But I always actually will make my first stop after that, North Carolina. So we'll definitely be catching up over there.
Well, wave at me while you fly over.
I'll visit you down in San Francisco. It's one of my favorite places. I love being down there.
Yeah. Certainly, I would like to thank Sasha for letting us co-op his wonderful show.
We stole your show.
We stole her show. I love your show.
For a very entertaining conversation.
All right.
I hope listeners enjoy themselves. And thank you so much. And see you next Wednesday. Thanks from IBM TV to everybody. Bye-bye.